an established uptrend has a larger correction after a final steep incline before a head and shoulders. It completes with the additional bearish features of a 3 methods falling candle formation. This is then contrasted with a reverse head and shoulders reversal that is slow to start due to persisting bearish sentiment as seen by the still moderate selling volume into June. This becomes an important factor with the failed ascending triangle that has overall weak bullish volume at the strong head and shoulders resistance range. The gap down then leads to a short-term bearish overextension. A wide double bottom forms with a more preferable increase in bullish volume with the second upswing. The firm base in the mid-90s and sustained moderate bullish volume into November becomes a key factor in overcoming the gap fill resistance that is wider due to the influence of the major 102 to 105 range. The resumption of the larger uptrend sees an aggressive bullish period begins after a gap up is not immediately filled. This is then followed by a classic failed head and shoulders with an inclined right shoulder and increasing bullish volume, while bearish volume drastically decreases to start the new year. All seemed bullish on the chart, but what happened? It was a case where technical analysis was largely irrelevant, at least for the later part of January due to the unpredictable market reaction to an earnings report. Prior to the weakening of the sustained downtrend, after the gap down, there is a good example of a flatter head and shoulders reversal in more of a continuation context. It could be said there was a large head and shoulders outline, but in this case it only led to a brief bearish acceleration and an equally rapid bullish reversal. This is in part due to the heavily bullish sentiment held at or under the low 90s during the steeper incline from late 2013. Similar to early 2015, technical analysis is largely irrelevant in later January around the time of the first quarterly report of the calendar year for UPS. Similar to before, there is technically the general outline of a head and shoulders composed of flatter horizontal ranges for the shoulders. However, this time the pattern fails as selling volume rapidly decreases into June, while bullish volume remains highly consistent at mostly normal levels. This eventually breaks the downtrend line to mark the solid establishment of the new uptrend. It is another case of a more passive rise, after selling volume was largely expended following the minor decline after the gap down. As expected, there is natural resistance near previous all-time highs in the 120 to 117 range, where a moderate correction originates from a triple top or flat top, depending on whether the bullish spike in late October is counted as a proper downswing. The first quarterly report of the calendar year doesn't always necessarily mean a guaranteed drop. However, it has been a recurring event for UPS over the past few years. This once again leads to a familiar gap down and neutral to bearish phase that follows. Essentially, there is a mostly passive rise as price reverses and establishes over the descending trend line from the last highs before the gap down. The head and shoulders reversal around the firm all-time high ranges is less effective and can be considered a less strict outline. This is due to flatter price action and less defined swing points, particularly for the volatile right shoulder, where there is still a bearish acceleration after clearing the 117 level that can be reused to mark the neckline. Similar to the start of this case study, a reverse head and shoulders counters a head and shoulders downtrend. Except in this case, it is a more extreme example in that there are gaps before and after the neckline. The main outline more closely approximates the closing prices rather than being widened to incorporate the high of the bearish star in late July. This leads to a declined neckline that still approximates close to the old 105 level. After the reverse head and shoulders uptrend line is broken, there is natural bearish price action that becomes increasingly more intense into December. More bearish volume leads to a failed ascending triangle. Another polarizing contrast, as a failed ascending triangle is followed by a successful descending triangle. The downtrend is accelerated further by small and medium-sized 3 methods falling formations. Similar to the last example with Uber stock chart, there is a key foundation of support at new highs following an aggressive recovery that incorporates a gap up and 3 methods rising price action. The mid-150s region becomes even more important since it marks the support base of the potential descending triangle. Technically, the smaller triangle is correct, as it presents the descending triangle outline in a continuation and not a reversal context.